Okay, so welcome to another deep dive with us today. And today we're diving into something that's really kind of got us scratching our heads.
Yeah.
We've got this article here from the Motley Fool, and it was just published yesterday, April 9th, 2025.
Fresh off the press.
Yeah, so for anyone who doesn't know, the Motley Fool, they've been around for a while, since '93, I think, and they have this whole, mission to make everyone smarter, happier, and richer.
Right.
And they put out a lot of content, right? Like they have premium investing advice subscriptions, but they also do a lot of just free market analysis and stuff like that.
Mm-hmm.
And that's actually the kind of stuff we're looking at today. We're not looking at any of their premium content. So it's important to remember that this is just kind of their opinion on things.
Right. And we always want to be transparent with everyone listening that, these are opinions that might be different from what you'd find in their subscriber-only content.
Right. Yeah, exactly.
So, full disclosure there.
Yeah. So the main thing that we wanted to get into today with this article that they put out is this really strange behavior we're seeing in U.S. Treasury yields.
Yeah, it's a head scratcher.
Yeah.
The global stock market, it's taken a hit recently, thanks to, President Trump's latest round of tariffs. And normally, under these circumstances, you'd expect investors to flock to safety, right? But in this case, we're seeing Treasury yields actually going up.
Yeah, it's like opposite land.
It really is.
Like the stock market is down and yields are up. It's like, what is going on?
Yeah, so that's what we're going to try to unpack today.
Exactly.
Why is this happening and what could it mean for your investments?
Yeah, so let's dive into this anomaly a little bit more. And the article really highlighted this right off the bat. Like, this is not normal.
Right.
So typically when you see the stock market going down, U.S. Treasuries are seen as that safe harbor.
Right, the safe haven.
Yeah, and so when people get spooked in the stock market, they run to Treasuries and demand for those goes up. And then, of course, when demand goes up, prices go up.
Right, supply and demand 101.
Yeah, exactly. And then usually that has this knock-on effect on yields pushing them down. But we're seeing the opposite right now.
Absolutely. It's like the financial world has decided to completely flip the script on us.
Yeah, it's like zig when you should zag.
Exactly. And this really boils down to that fundamental inverse relationship between bond prices and yields, which can be a little tricky to wrap your head around sometimes.
Yeah, definitely.
But the article gives a great example to illustrate this. So imagine you have a $1,000 Treasury bond that pays a 4% yield. That means you're getting $40 in interest every year.
Okay.
Now, let's say for whatever reason, the price of that bond drops on the open market, say it falls to $925.
Mm-hmm.
It's still paying out that same $40 a year in interest, but because you could now buy it at that lower price of $925, your annual return, your yield effectively becomes higher. In this case, it would be around 4.3%.
Oh, okay.
So lower prices translate to higher yields and vice versa.
Okay, that makes sense.
So typically in a stock market downturn, that surge in demand for treasuries drives their prices up. And as we just saw, that pushes yields down.
Right.
But like you said, we're seeing the opposite right now.
Yeah. So the big question is why? Why are investors not running to treasuries? Why are some maybe even selling them off during all this stock market craziness?
Yeah, it's a good question. And the article puts forward a few really interesting possibilities. And I think what's really interesting here is that there could be a number of things happening all at the same time.
Yeah.
So the first theory the article talks about is this idea of margin calls. So, you might have heard of hedge funds using borrowed money to invest in stocks. That's called investing on margin.
Right.
And if those stock prices suddenly drop, their brokers might demand that they put up more cash as collateral to cover their potential losses. So to meet these demands, some hedge funds might be selling off their more liquid assets, things like, U.S. Treasuries, to raise that cash quickly rather than selling even more of their stocks, which have already gone down in value.
Right. So it's like, I need cash now.
Exactly.
So I'm going to sell what's easiest to sell.
Exactly.
Clear.
It's like, if you think about it like a security deposit, when you're renting an apartment, if you damage the apartment, the landlord might ask for more deposit to cover the potential cost of repairs. It's a similar concept.
Oh, okay. That makes sense.
So in this case, hedge funds are selling their treasuries to make up for those losses in their stock portfolios.
Right. So basically sell what's easiest and least painful in the short term.
Exactly.
To cover the stuff that's really, volatile and causing problems.
Right.
Okay, so that's one possibility.
Yeah.
The second one that the article talks about is this idea that investors just want cash right now.
Right.
Like, given all the uncertainty with these new tariffs and, who knows what's going to happen with the markets, people might just be thinking like cash is king right now.
Yeah, I think that's a very natural reaction when things feel uncertain.
Yeah.
You want to have that flexibility to act quickly if you need to.
Right.
So holding cash gives you that option.
Yeah. And especially over something like Treasuries, which, people think of as safe, but maybe they're not feeling so safe right now.
Exactly.
Yeah.
And if you connect that to, the overall market sentiment right now, there's a lot of fear. And that fear can be a huge driver in the financial markets.
Right.
So when the future looks unpredictable, people tend to gravitate towards what feels the most secure. And in this case, that might be cold, hard cash.
Okay, so that's the second possibility, just this broad desire for cash.
Yeah.
But then things start to get a little bit more serious with this third possibility that the article brings up.
Right.
This idea that U.S. Treasuries might be becoming a pawn in some kind of global trade war.
Yeah, this is where things get really interesting and potentially concerning.
Yeah.
So think about who holds the most U.S. Treasury debt. It's governments like Japan, China, the U.K.,
Right.
and these are also some of the countries that have been hit hardest by some of these new tariffs.
Yeah.
So it's not hard to imagine that they might be a little bit upset and maybe even looking for ways to retaliate.
Right.
So the question becomes, could these countries be intentionally selling off their U.S. Treasury holdings as a way to kind of, hit back?
Mm-hmm.
Or maybe they're not selling yet, but just the fear that they might start doing that is enough to spook other investors and make them want to get rid of their U.S. dollar-denominated assets.
Right, yeah. Like, if everyone thinks China's going to dump all their treasuries,
Exactly.
then everyone else is going to be like, well, I better get out before the price tanks.
Precisely. It becomes a self-fulfilling prophecy.
Yeah, and to be clear, when we say U.S. dollar-denominated assets, we're not just talking about treasuries.
Right. We're talking about anything that's priced in U.S. dollars.
Yeah.
So that includes things like U.S. stocks, corporate bonds, all sorts of things.
Okay, so basically anything that is tied to the U.S. dollar could be affected by this.
Exactly.
Wow, that's kind of scary.
It is a little unsettling because it really challenges this long-held assumption that U.S. Treasuries are the ultimate safe haven.
Yeah, like we're so used to thinking that when there's a crisis, you just buy treasuries.
Right.
And you're good.
Yeah, and historically that's been true, during stock market declines. Treasury yields typically fall because everyone's rushing to buy them.
Right.
But the fact that we're seeing the opposite happening right now suggests that this time might be different.
Yeah, and the article actually does a good job of reminding us of this historical context.
It does.
Like, it really emphasizes that this is not normal.
It's not.
Okay, so we've talked about why this is happening.
Right.
But what does it all mean for the average investor?
Right. That's the million-dollar question.
Yeah. So the article highlights a few things to consider.
Mm-hmm.
And the first is if you own treasury bonds and you're planning to hold them until they mature.
Until maturity.
Yeah. Then all this market volatility shouldn't really affect you.
Right.
You'll still get your initial investment back, plus all the interest payments that were agreed upon when you bought the bond.
Exactly. You're essentially locking in that initial yield.
Right. You're in it for the long haul.
Yeah.
But what happens if you need to sell those treasuries before they mature?
That's where things can get a little tricky because if the price of those treasuries has gone down since you bought them, and remember that's why yields are going up right now,
Right.
you could end up selling them for less than you originally paid.
Yeah. And that would mean losing money.
Exactly. Just like selling a stock at a lower price than you bought it for.
Right. Okay. So that's something to keep in mind.
Definitely.
And it's not just individual investors who might be affected by this.
Right. The article also talks about treasury funds,
Oh, yeah.
which are basically these baskets of treasury bonds that are held within mutual funds or exchange-traded funds.
Right.
ETFs.
Yeah, ETFs, exactly.
Okay.
And just like with individual bonds, these funds are also affected by changes in treasury prices.
Right. So if treasury prices keep going down, then the value of these funds is also going to go down.
Precisely. And that would impact anyone who's invested in those funds.
Okay. So the bottom line here seems to be that treasuries might not be as safe as we used to think they were.
Yeah, I think that's a fair assessment.
Like, we always thought of them as this rock-solid investment.
Right.
But now it seems like even they can be affected by all this global uncertainty.
Yeah, and the article uses this really striking phrase, Trump tariff hurricane.
Yeah, I remember that.
And I think that really captures the feeling of this unexpected turbulence.
Yeah.
Like, we're used to treasuries being the calm in the storm, but now it seems like they might be getting caught up in the storm themselves.
Right. And so the takeaway here is that even though treasury yields are going up, that might not be a good thing. They could actually be a sign that things are riskier than they appear.
It's a bit of a paradox, right?
Yeah.
Higher yields typically signal higher risk, So it's important to understand why those yields are rising before you just jump in and buy treasuries thinking you're getting a great deal.
Right, like don't just blindly chase those higher yields. You really need to understand what's driving them.
Right, and as the article so cleverly puts it, jumping into treasuries right now without really thinking about these risks could be, well, foolish.
Yeah.
So the stability that we've always associated with treasuries might not be so certain anymore.
Right.
And I think that's a really important point for investors to remember.
Yeah, so this whole situation with treasuries being potentially used as a tool in these trade wars, it kind of makes you wonder what other seemingly safe investments might be at risk.
It really does.
Like we're living in a crazy world right now.
We are.
And it feels like anything can happen.
It does. And I think this is a good reminder that even the most conservative investments can be affected by events that are completely outside of our control.
Yeah, like you can't just assume that something is safe anymore.
Right. You have to really do your research and understand the risks involved.
Yeah, and be prepared for the unexpected.
Absolutely.
Well, on that note, I think we'll wrap up today's deep dive.
Sounds good.
Thanks for listening, everyone, and we'll catch you next time.
See you then.